Hey, good morning once again, options traders. Happy Monday, and I hope everybody had a fabulous weekend. Looking forward to potentially another wild and wacky week on Wall Street. So for today, I wanted to talk about a post that I got, I think it was last week, from one of our traders asking, should you use long-term synthetic stock to collect a dividend? And I gave a fairly short response on the Facebook group, but it's a really good question. I have had this question before, so I thought let's make a video on it just so that everybody can see and understand why this would be a really bad idea. So before we get started, as always, please be sure to click like and subscribe. Definitely very much appreciated and goes a long way into promoting the channel. So before we even get started, I want to address probably a more important question. Do dividends even matter? Now, for those of you who have had finance classes will certainly remember the Modiani and Miller irrelevance proposition. And basically what this says is that capital structure doesn't affect a company's value. So in other words, whether a company pays dividends or whether it doesn't affect the company's value. And so the first question you have to ask is, why would you want to embark on a strategy where we're just going to collect dividends? It might seem like free money, but also remember that the value of the stock, that stock's price, is reduced by the amount of the dividend. So if you have a $100 stock today, it's worth $100. If it pays a $1 dividend tomorrow, you've got stock worth 99, but you've got $1 in cash. It's still worth $100. So again, you have to say, would we even want to go down this path? But that aside, we're going to assume that for whatever reason, a trader wants to collect dividends, and we're going to ask, would it make sense to use long-term synthetic stock? So to answer that question, synthetic stock, what is it? Well, we've talked about it before. Remember, it's a strategy where you will buy a call, you will sell a put, and it will be the same expiration and strike. That's important. And for instance, let's say that you buy the June $100 call, maybe trading for $5.25, and you sell the June 100 put trading for $5. So if you pay $5.25 and you receive 5, on a net basis, you've got 25 cents spent. So if this is an at-the-money option, it's just simply the cost of carry. Now, before you get too excited and say, wow, that's a really cheap way to control a $100 stock, there will be a margin requirement for the short put, usually about 20%, maybe closer to 25% for an individual stock. But again, if you wanted to make the argument that you wanted to collect dividends, it's still a much cheaper way to control the stock. So here's what this position would look like. Again, we're going to buy the June $100 call and sell the June $100 put. Looks just like shares of stock. That's why it's called a synthetic stock position. Remember, a synthetic position means we're not using the actual asset that we're trying to replicate. We're using different combinations to get the same risk graph. So take a look. We have the 100 strike. For all stock prices above 100, we have unlimited gains, just like a long stockholder. And for all stock prices below 100, we have unlimited losses, at least all the way down to 0, also just like a long stockholder. There absolutely is no difference. But now let's take a look at the dividends. If you own shares of stock, you will collect all of the dividends, at least through the time that you're holding those shares. But if you're going to do the synthetic stock version, you're only going to collect one dividend. Why is that? Well, because in order to get that dividend, you must exercise the call. And of course, when you do that, it should technically be done just before the X date. But regardless of when you exercise it, that call is gone. It's dead. So you're not going to get the next dividend or the next one unless you go out and buy another call. Now, another condition that we should have before we exercise this call is that the call should be trading at parity, or at least very close, maybe a couple of pennies of extrinsic value. So recall what parity means. It means that the call's value is coming all from the intrinsic value of the option and little to no extrinsic value. And at that point, the call option is behaving exactly like stock. That's why it's called parity. Parity is just a fancy word for equivalence. The call and stock are trading exactly the same, delta 1, gamma 0. So that's something else we need to see before we decide to exercise this call. So for example, let's say that the stock is at 105 and the $100 call is trading for 5, that's at parity, and the $100 put is trading at 0. So if we saw this condition here, we would say, okay, the $100 call is trading at parity, it's just as good as stock. You have the right to pay $100 for stock worth 105, but you're also giving up the $5 of value on that option. So they're just two different ways of accomplishing the same thing. That would not be a bad financial decision to exercise that call the day before the X date to collect that dividend. But let's say that that $100 call was trading for 6 or even $5.10, $5.20. Probably not going to be a good idea. Why? Because the extrinsic value makes it a better deal to just sell the option, just sell that call option outright and just buy the shares. So if you saw that your call was trading for $6 and you wanted the dividend, just sell the call for 6, go out and buy the shares. But it wouldn't make sense to exercise that call and throw away that dollar's worth of extrinsic value. So once you keep that in mind, let's now come back to the main question about long-term options. Let's say that you wanted to buy a 1-year $100 call, maybe trading for 30 bucks, and you wanted to sell a 1-year $100 put, maybe trading for 28. Yeah, it's going to cost you $2 to synthetically control shares of stock. It's just going to be for the cost of carry. However, if you exercise this call, you are pitching away $30 of extrinsic value. It's gone for good, flushed down the drain, because you don't get to exercise it and close it. You get one or the other. So if you exercise this call, and it doesn't have to be $30 of extrinsic value, maybe time has gone by and there's now 25 or 20, it's still not a good deal. You're going to be throwing away far more value than you're going to be collecting in that dividend. And not to mention that you're now holding all of the downside risk in the stock. And so the answer is, which is what I posted in the Facebook forum, never use long-term options for dividends. Short-term options aren't going to work. This strategy using 30-day options is not going to work. 15-day options are not going to work because they will have some extrinsic value on them. So again, you'd never use long-term options to collect dividends. So it's a really good question, but I hope everybody at least understands it, because I have heard where people will do this. They'll say, oh, the stock's about to pay a dividend and I've heard you're supposed to exercise a call. That is not true. It's just that if a dividend is about to be paid, it might be a good idea to exercise for that dividend. But like all decisions for options, there are a number of assumptions, and that's what you need to know to make better decisions. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.